Listen to this story. You wake up in the morning, then you open your trading platform to start trading. Then you start thinking, should I buy or should I sell? Is the market trending up or is the market trending down? And what are my indicators saying? And some of them tell me to buy, others tell me to sell. Oh, but I'm hitting a resistance or I'm hitting a support, and there's so much information that you start thinking, what should I do now? But normally if you get overwhelmed, feeling lost with all the amount of information regarding financial markets, don't know exactly what to do, or you don't know exactly what to analyze before placing a trade. This is what I'm bringing to you today. Hey everyone, I'm Pedro, and today I'll teach you the 5 steps that you need to take before placing any trade in the market. Before we get started, make sure that you subscribe to this channel and click the alert notification. That way when I release more content like this, you will get notified. So let's start this. So guys, let's start with step number 1, which is the market structure, and we need to know what path is the market following. If it's going up, following an uptrend, or if it's going down, following a downtrend. And I like to use moving averages to analyze my trend. And the moving average that I use is the 20 period simple moving average. While the price is above the moving average, and the moving average is this blue line that we have here, while the price is above this moving average, it's on an uptrend. When the price crosses the moving average to the downside, this is a zone where the price can switch to a downtrend. You can see that the price started going down and the moving average started to adapt to the movement of the price, also going down. And at this point, the price crossed to the upside of the moving averages. Here it started to try to make an uptrend, but then it started to move sideways. It was not going anywhere. You can see that it was going up and down, crossing moving average to both sides. During this whole period here, you can see that the price was not respecting the moving averages. Trading ranges are more difficult than trading trends, and most of the ranges are not perfect. You may have different support or resistance zones to choose from, and the potential rewards are usually very small, so you can't take advantage of a continuous price movement like what you do when you ride a trend, where you can have a huge reward while the price keeps moving in the same direction. Although you can make money trading ranges, I personally prefer to stay away, and especially if you are a beginner, I would focus on trends and avoid ranges. And what happened after this range? The price broke the moving average to the downside, and that's when it started a downtrend. And this is how you identify the market structure. Price crosses to the upside of the moving average, starts an uptrend. The price crosses to the downside of the moving average and starts a downtrend. So this is the first step that you need to take before placing a trend. You need to know if the price is on an uptrend, you need to know if the price is on a downtrend, or you need to know if the price is ranging and moving sideways. Step number 2, you have to identify the key zones. Key zones are zones where buyers or sellers may appear. You don't want to buy or sell when the price already made a big movement. That's where most beginners are attracted to make their trades. And what happens when they do that is that they end up having very big losses because they are buying high. And when they profit, their profits are small because they are buying exactly when they should be closing their trades. And what are the key zones that I use? To enter my trades, I like to use the 8 period moving average and the 20 period moving average. Every time that the price touches one of these moving averages, that's where I start looking for a trade. That's when I start to look for an entry. I use the 8 moving average for strong trends, and I use the 20 moving average to take trades when the price is trending but not on a very strong trend. You can see here the price is above the moving averages, and when it touches, in this case it touched the 20 moving average, it made a movement to the upside. Here it made another touch on the 20, and it was basically a touch on the 8 and 20 at the same time, and then it made a move to the upside. And here it touched the 8 moving average and it made a move to the upside. And here it touched two times 20 moving average, and here the 8 and the 20 again, and then started going up. This is always the same, guys. The price comes back, touches moving average, goes up. Price comes back down, touches a moving average, it goes up. Price comes back down, touches moving average and goes up. Price comes down, here it touches the 20 moving average and goes up. This is always the same until it changes the trend. So it crosses the 20 moving average to the downside, and now we start looking for sells. And where do we start looking for sells? When the price comes back to the moving average, this is when we start thinking about selling. When the price goes back to the moving averages, that's when we think about selling. When the price goes back to the moving averages, that's when we think about selling. Another key zone that I like to use are supports and resistances. We want to identify zones where the price changed the trend previously. And the stronger the change of the trend, that's when the supports or resistances tend to be stronger. And we shouldn't look at resistances or supports as a very thin line. We should look at them as some kind of zones with some width. And you can see here that the price had some trouble to pass through this support. Price came down, it hit this support zone, it went up, it tried the second time to go down, but felt this support here, and now it's starting an uptrend. And since it started an uptrend, it's above the moving averages. What I'm looking here, it will be for the price to come close to the moving average and then catch another leg to the upside. While it keeps above the moving average, I'm only looking for buys. And what would be my possible target? Maybe this zone here, where the price changed the trend previously. And here it's what we call a resistance zone, and here it's what we call a support zone. So this kind of zones where the price changed the trend previously, those are good targets that we may have for our trades. Step number 3, entry triggers. Entry triggers are what will make you hit your buy or sell button. I have several patterns that I use to trigger my entries, and those patterns are nothing more than rejections from key zones. So we saw previously that the key zones are the moving averages that we see here. So when we are on an uptrend and I see the price coming to a moving average, and when it comes down it's a red candle. Later, when this red candle is removed, is deleted by green, this is where I click my buy button and I wait for a leg to the upside. Then I see the price coming to the moving average again and I see a red candle. When I see the red candle being deleted by a green candle, this is my trigger to buy and wait for another leg to the upside. And this is always the same thing, guys. I see the price coming back to the moving averages. When I see a green candle deleting a red candle, this is another trigger to enter my trades. Then we have a downtrend, the price is going down. So this is the same concept. The price comes to the moving average. Here we have a green candle with a wick at the top. And when the price breaks this green candle with a red candle, this is my trigger to enter a sell trade. Then the price comes to the moving averages again. This small green moves to the upside. And when a red candle breaks a green candle after a touch on the moving average, this is another entry for me to take a sell trade and catch another leg to the downside. I'm not going into much detail about all the setups that I use, all the patterns that I use, but this is basically the main rule. I see just colors being deleted by the opposite color, and that's my entry. Now let's go to step number 4, and this one is very important. When you are wrong, where do you get out? We need to know when to cut our losses. If we don't cut our losses quickly, That will harm our account balance very quickly, and we don't want that. We want to have the smaller possible losses. So where would I get out of a trade? So guys, let's say that I see the price here coming to this 8 moving average, and then I see this green candle deleting this previous red candle, and I enter here. And if this distance is not enough for me to take profit, I see the price coming back, and it actually changed the trend to the downside. It broke the 20 moving average. So where would I close my trade? Where would I put my stop loss? The main rule is to get out of your trade when the reason of your trade was violated. When the reason of your entry was violated, it doesn't exist anymore. And what was the reason of the entry? The reason of the entry was the break of this red candle. So I would put my stop loss here at this bottom, and if the price breaks the bottom of this candle, it means that the reason of my entry was violated. It doesn't exist anymore, so I get out of my trade. And let's look at another example. Here the price made a move to the downside, and then it made this pullback to the upside. What would be my entry? My entry would be when this green candle was deleted by red. I could entry here, for example. Price touched the previous low, but it didn't break it. And if this move here was not enough for me to take profit and the price came back to me, where would I close my trade? I will close my trade when the reason of my entry is violated. Where would be that? Exactly at the top of this red candle. So if I didn't have enough space to take profit, the price comes back to me, this is where I would close my trade, exactly when this green candle breaks the high of this red candle. Now, step number 5, and this one is very important too. Where do you close your trades when you are right? There are several ways. You can close your trade completely, you can close your trade partially, in steps, or you can close your trade when the price hits supports or resistances. One thing that I do is to always have a one-to-one risk reward. So let's say that I'm taking this trade here. This green candle breaking this red candle here. I would protect my trade there at the bottom of this move, of this pattern. Then I like to wait first for a break of the previous high, which was here, then at least one-to-one risk reward. So if we have here our risk, I would project the same distance to the upside, and here would be my reward. So I don't like to close my trades before my profit it's at least one-to-one risk reward. So here could be a potential zone where I could close my trade. I also use other methods like trailing stops. So as the price keeps moving up, you start adjusting your stop loss, you start adjusting your stop loss, you start adjusting your stop loss until at some point your stop loss will be hit. That way you can maximize the gains, you can maximize the reward that you can have on each trade. There are several types of trailing stops, and I'm not going into them into this video, it will be very extended, but this is something that I like to use. And another rule that you can use to close your trades, if the price is on a clear uptrend, for example, like we see here, and I don't know what's here on the left, but let's say that there was a previous resistance here at this zone. You can try and let the price go and hit this resistance zone. So you enter here, you put your stop loss there with just a small risk, and then you try to catch this big reward. So these are different several ways of closing your trades. One important thing to know is to always use the same rules. You need to have these rules on your trading plan and always use the same concept, always use the same rule to be consistent. When you have defined rules and you always follow the same rules and you act on a consistent way, that's when you start getting consistent profits. Now, just to quickly recap, we have step number 1, which is the market structure. We need to identify if the market is on an uptrend, if it's on a downtrend, or if it's moving sideways, ranging. And you know that I use the 20 period moving average to identify this. Then we have the step number 2, we have the key zones, we have the moving averages. That's the one that I use. You can have different ones depending on the strategy that you use. I like to use the 8 and the 20 period moving averages. And the other key zones that are also important are resistances or supports. And then we have step number 3, we have our entry triggers. And entry triggers are the patterns that we see on our charts that make us hit our buy or sell button. Then we go to step number 4. It's when to get out when we are wrong. Should always get out with small losses. And finally, step number 5. When we are right, we should get out with big profits. That's how we balance the equilibrium between the losses and the profits. It's always better to go for bigger profits than losses. And guys, just to finish the plan, you need to have these rules on your trading plan, and then you need to follow these rules. You need to follow them consistently. That's the way to get consistent results. You do different things every time that you trade, you will not be trading consistently, and you are not going to have consistent results too. So guys, I hope that you liked this video. If you did, please leave a like, smash that like button and subscribe to this channel. And let me know in the comments which of these steps do you already have on your trading plan and which ones are you going to add. See you on the next video, and don't forget, and trade safe.